Well, some very interesting data on China. If you look at the last 20 years, China's market valuations have been lower than where we currently are on only 4 instances. Right now, it trades at 12-time price to earnings. So only 4 times before this in the last 20 years has it been below that. Moneyfront has helped me out with some data here. The 4 episodes were in October of 2008, September of 2011, June of 2013, and then October of 2022, which is the most recent. On all of these instances, the 12-month forward PE fell to between 7.7% to 8.3%, like you can see over here. But in the months that followed, the market staged a big recovery. So in the 14 months after the October 2008 fall, the market recovered 88%. In 2011, if you look at it, the market recovered 39% in around 16 months. Then you have June 2013, where we saw a rise of almost 60% in a period of 22 months. And then lastly, the most recent, like I mentioned, was in 2022. And in a period of only 3 months, the market saw a big jump. It surged 53% from those lows. Now, this is what has happened historically. I want to highlight that while, we have seen big bounces in the past, and of course, we could see that again, there are some factors which stand out as different from previous instances this time. For example, the Chinese property market is in trouble. Further, the economy is sort of in a transition toward more value-added sectors. That's not something which is going to happen overnight, and it will take some time to stabilize. This is clearly hurting investor sentiment. So that is what is different with China this time. That said, the index was up 2.5% last week. It has been up 12% in the last month. And this week is very important for China because it is expected to lay out their growth targets, and there are hopes of some stimulus. It's very divided, but there are people who believe that there could be some kind of stimulus in order to boost the economy. With this context, if you as an Indian investor want to play the China market, and of course, please remember, this is a very high risk, kind of fund that you would be looking at. There are 4 funds within India that you could potentially look at. First, you have the Edelweiss Greater China Equity Offshore Fund. You have the Axis Greater China Equity Fund of Fund. You have the Miri Asset Hang Seng Tech ETF. And lastly, you have the Nippon India ETF. Now, the returns over the last many years for all of these funds have, of course, been very weak because the market has been very weak. The Edelweiss Greater China Fund, this is the largest one. It actually also has the highest expense ratio of 2.3%. The returns are quite bad, like you can see on your screen. It's down 15%, 16% for a 1-year period. Similar if you look at a 3-year period as well. The Axis Greater China Fund charges an expense of around 1.6%. The 1- and 3-year performance both down around 12%. And then you have the Nippon and Miri. Now remember, these are ETFs. These are passive. So the management cost is much lower here. Nippon charges you 0.9% and you have Miri which charges you 0.6%. The returns are very weak here as well. I mean, it will show up on your screen because the market has not done well, of course. But if you as an Indian investor feel like you want to play China at these levels, then these 4 are your options.